The spread between the 5-year U.S. Treasury and the 30-year U.S. Treasury, which hardly anyone pays attention to, but I look at it every day, has been steepening the whole time. When the stock market cratered, the 30-year Treasury bond yield widened to the 5-year. When the stock market roared back, the 30-year Treasury continued to steepen versus the 5-year. Why is that? And I think the reason is that people are starting to realize that and I hate to go back to this issue, but it's so fundamental, that the deficit and the national debt are totally out of control. Last year, 2018, the national debt, forget about the deficit, which isn't really the amount of true borrowing, the national debt increased by over 6% of GDP in 2018. Nominal GDP rose by 5.1. What that means, Judge, is that if we hadn't increased the national debt at all in 2018, GDP nominally would have been negative. And in fact, that's the truth for the last 3 years and the last 5 years, that the national debt growth is responsible for all of the growth in U.S. GDP. So if we're growing debt so much during a 5% nominal GDP period, and you ticked off some economic facts that are reasonably reassuring, what's going to happen when we turn down? And this is the focus that I've been thinking about, the thing that I've been focusing on for a long time. I mean, in the next recession, what's going to happen to the amount of debt, and is the Fed going to allow interest rates to rise at the long end, which is what's going to happen unless they go and emulate the ECB and the JGB. And that kind of, I'm getting a little bit ahead, but that's kind of what was underneath my recommendation at Sohn.
It's not only the national debt that seems to be concerning to some. There's an article today that some on the Fed are worried about the high levels of corporate debt. Chamath Palihapitiya of Social Capital. I visited with him out in San Francisco earlier this week. Yes. You guys have had your thing on Facebook in the past, but that notwithstanding,
I'm not aware of that. But okay, I don't. Oh, he's a Facebook guy.
Yeah.
Oh, I see. Well, so, it's Facebook is well off its highs.
That notwithstanding, the issue of high levels of corporate debt.
Absolutely. That's been something I've been talking about as well. The corporate bond market was not really a problem in the Great Recession. It got dragged down due to all the economic mess that we were in. But the setup of the corporate bond market is so much worse today than it was in 2006. First of all, it's about triple the size. The triple B market is bigger than the junk bond market. And there was this report by Morgan Stanley Research, which really is worth taking a look at, that says that if you use leverage ratios alone, and there's other variables that rating agencies use, but it seems to me leverage ratio is a really important one when it comes to creditworthiness. If you use leverage ratios alone, fully 45%, not just of the triple Bs, of the entire investment-grade corporate bond market, most of them are probably triple Bs, but some of the even higher-rated ones would be junk right now. Right now. Think about that. You've got about an $8 trillion corporate bond market, and that means that the amount of downgrades into junk from investment grade, if those statistics stay unchanged, would be bigger than the amount of downgrades in the subprime market.
So what's the spark then?
It's a recession.
It's so concerning, what's the spark? That's it, a recession.
Yes, a downturn. The economy is in such bad shape to withstand a downturn. Again, the national debt is exploding while we're having some of the best GDP year over year that we've had in recent years, right? So the economy is not in any kind of condition for the government to come to the rescue other than really wickedly extraordinary policies a la the ECB and the BOJ.